Let's wait a few more seconds. Okay. Hello, everyone. Thank you for joining us for the webinar, The Art of Fundraising, from Term Sheet to Final Deal. I'm Dana from APACMed. APACMed is a trade association representing all the different stakeholders in the medtech industry in Asia. Please note that at the end of this session, we will have Q&A, so you are more than welcome to raise your hand and ask questions. So I'm happy to have here today Augustus Loi and Victor Tan, both from SGInnovate. So Victor, over to you.
Thanks, Dana. Hi everyone, my name is Victor and I'm the Director of Venture Investing at SGInnovate. I want to give a quick introduction to our organization so you know a bit more of where we're coming from. SGInnovate is a private investment fund that is owned by the Singapore government, and our key role in the ecosystem is essentially to help to build up the deep tech space, right? And that involves us making investments, growing talent within Singapore, at the same time also, trying to work on bringing all the folks within the deep tech ecosystem together. And today we're super excited to share, a bit of what we do every day in terms of looking at companies who are fundraising, and working with founders also at the same time. I'm going to pass this to Augustus, who heads up all our healthcare investments, and he's the best person to actually share, how we actually go about doing this on a daily basis. Augustus, over to you.
Thanks, Victor, and thanks everyone for getting on this seminar today. So I'm going to talk today a little bit about how to fundraise, and I'm going to give you, just to contextualize, this is something that I usually share with a startup, for example, versus from a VC side. So for a lot of the companies that we've been attached to from EF, for example, going through their first fundraise, I think this is a nice structured way in which they can go about it. And of course, I think as we're all familiar, if we're coming from a scientific or a research background, we got to caveat everything, which is in this case, we're talking about fundraising from a VC, number one. We're going to assume that this is your first fundraise. And then we're also going to assume that you're doing something in a regulated medical device kind of a way. If you're doing services or you're doing biopharma, there might be some variation in terms of your strategy and who you speak to and how you structure things out. But I think there are some things that maybe could also be learned. But generally, I would say this is on a regulated medical device side. And then, of course, we're looking at things that are fundamentally businesses. So the business, the economics, makes sense in a way that it's a VC business in that way. So let me just jump right in. So my name is Augustus Loi. Obviously, I'm heading up the healthcare deals at SGInnovate. So just to give you some examples of things that I've done in the past, I did our first early stage investment in NDR Medical a couple of years back, and now they've obviously gone on to fundraise from Microport, strategic investor, and done some interesting things. I've also done our overseas deals, like Health Beacon was our first overseas deal. So we don't just do Singapore investments, but we also do a bit of overseas as well where they make sense. And in terms of the scope of the portfolio that I've done, in case you're interested and you have some questions, then these are some of the examples. So it's everything from hardware and robotics. So the hard side, like NDR Medical, or even something that's coming up, our 10th portfolio investment, which we should be announcing quite soon with a big player in the robotics space, to pure software plays like C-Mode and Meadow. Obviously, in terms of my own self, areas I'm interested right now are brain-computer interfaces, novel digital biomarkers, anything in the mental or the neuro space, as well as onco, because everyone's interested in onco. So if you are in any of those and you just want to chat, I think those are some interesting things that we can talk about as well. So what I'm going to talk to you today about is I'm going to touch very briefly on a bit of the why and the when for VC, but then I'll get into the nitty-gritty of the how. But it's important to kind of contextualize why you're looking at VC and when, so that you know how the how actually makes sense. And then at the end, we can get into a couple of questions if you have them. So number one, why take money from VC instead? You don't have to. It's completely voluntary. There are lots of other examples of financing in market that you can go about. There's obviously grants in Singapore. We have a strong infrastructure on that. There's angels, there's loans, there's crowdfunding. But if you're coming to a VC, that's a decision that you're making, and we're going to make certain assumptions about the business. Number one, there are both financial and health outcomes. So if you're just looking at if you're just looking at a health outcome perspective, then there are some other vehicles that make a bit more sense. But for VC, those are things we're going to assume, number one. And number two, we're going to assume that there's some kind of an exit that we're planning in mind. And I think, so this image comes from Billions, in case anyone has been watching, which gives a little bit of a twisted image of what VCs are like, but I'll just say that not everyone is like that. And there are certain benefits when it comes to taking VC money. Number one is obviously the network. We're probably some of the most networked people around, and that's how we got into the business. Number two is in terms of experience. So with 9 or 10 portfolio that we've done, who've gone through similar stages from the seed to the Series A to fundraising overseas and going through regulatory process, then we can share with you some of the things that our startups have learned along the way if you're going through this for your first time. Then of course, there's a signal of value because we are evaluating this opportunity from a very structured perspective as fund managers, and we're going to insist on certain level of governance on an ongoing basis. So that means that as a company, it can be a signal of value that you're taking VC money in the first place. And of course, when to ask for VC money. So I think this has got to do with risk, and it's going to be different from VC to VC on what kind of risk they are willing to accept. So at the early stage, I think we can generally accept a little bit more risk, but there are 3 different kinds of risks that you can consider. Number one is product and technology risk, so the stage in which the product is developed and any kind of engineering challenges down the line. I think most VCs will be comfortable in assessing this component with you. Then there's commercial risk, and commercial risk is usually I would say the risk of the company being able to commercialize and sell on the market. But obviously, knowing with healthcare, there are things that come in advance, like regulatory. So when we think about commercial risk, rather than just sales itself, which you might not be in a position to do because you're not registered yet necessarily, then we can look at other ways to assess regulatory risk, and then we can make a judgment on whether or not this stage is reasonable for us. And for some other VCs at the A stage, maybe they are interested in something that's a little bit more concrete, whereas for us, we'll look at the math and we figure out whether the economics actually make sense. And then the last part is regulatory risk. So when we first got into healthcare, and I think a lot of the VCs who are coming into healthcare, they always think of regulatory risk as a bit of this black box. We don't know what's going on, and if you go in and if you fail, then you're dead or something like that. What I can tell you is that from our experience, regulatory risk is a manageable process. There are advisors who've done hundreds of these kinds of submissions over their lifetime. Most regulators are going to be receptive to working with you to a certain extent to make the process as transparent and structured as possible. So it's not really a black box. It's only a black box if you think you don't know what's going on and you haven't checked. But for us, when we went into NDR, for example, before the submission and a couple of the other startups, regulatory risk is always something that people are concerned about, but for our perspective coming early, it's something that's manageable, and so we are generally fine with that. But we always think about risk. The more you de-risk, obviously, the higher the valuation opportunity, and this contextualizes how you engage with a VC. So we're coming in as a shareholder into a startup as an investment. So when the money goes in, we want the money to go towards achieving a value inflection point. So that could be regulatory, it could be commercial, it could be product. But the idea is to then get to the next valuation, to fundraise up to the point in which the asset is meant to be sold. So that's how VCs engage with the startup. And I think when it comes to healthcare, where it's a double bottom line, I think we sometimes confuse that, and also as an entrepreneur, we might take it personally because there's a lot of risk involved on your side. But from the VC side, we have to be conscious that we are fund managers, and we also have a fiduciary responsibility to manage the money. So that's something that you want to consider when you're going into a conversation with a VC. So when is the right time? I think this is just an example that I've taken up on the internet in terms of the life cycle of a medical device. So it also depends on what kind of risk profile you are, whether you're class 1, class 2, de novo, breakthrough. But generally, most startups will come in at the first stage after they've completed the design and product development, and they'll raise to get into some clinical validation. And then they'll raise for the next value inflection point. So this is something you can refer to think about what are the steps that you've done when you go to a VC, and what do you actually need to achieve with the money that's going in. And so now we come into the nitty-gritty, how to fundraise, 4 steps or more. So there are 4 different phases, I would say, quite distinctly, and this is how I would structure it. If you look at it, and I'll definitely get into some of the details as we get into each of the phase, but overall, I think you should be looking at a 6 to 12 month timeline if you're doing it for the first time. And some things are parts, the timeline is in your control, and then some things, the timeline is not really in your control, so there's nothing much you can do about it. So you come to completion, the legals, that's really not in your control. But there are some areas in which you actually have control, and I'll talk a little bit about that. And obviously, the first and the second phase is the one where you're the most in control, I would say. But when it comes to preparation, you might go to market or to the VCs and find that the materials are not enough, or they ask for more materials, and there are some questions that they might ask you don't have the answers for. Then you go back to your preparation phase and you kind of cycle through that process until you get to the point where we are locked in from an interest perspective. So I think in the first fundraise, your first time going out to market, we should expect there's a bit of trial and error. So you might move through these, but generally, I would say once you get into 3 and 4, the process is pretty straightforward. The VC controls the process, so that's a little bit less on your side. So phase 1, preparing for a fundraise, I'd say this can take 1 to 2 months. This is really up to you and how long it takes you to prepare your strategy and your materials. And I think as VCs, we are conscious. It's your first time. You maybe don't know everything that you need to prepare, but let's try our best to have things in place. But generally, you're in control of this process. And we think about the objectives for this phase. Number 1 is create a story around your fundraise and the materials that support it. Number 2, start researching the VC targets that you're interested in. Then number 3, devise an engagement plan to get to the VCs. So this is kind of like a standard business development kind of approach. So we start off by just being clear on what is your business model. So we know when you start a company, yes, you have the registration, but the business model exists in your mind as a concept. There are lots of parts that are still work in progress. There are lots of things where we don't know how it's going to work out, but you should at least be quite clear in your head on the business model as a concept and how it works in the different parts. And the 2 things that we want to assume is number 1, it delivers health outcomes, and number 2, it makes money doing it. But how you go about doing that, I think there's some tools that I can refer you to, so that's not really part of the scope necessarily of this seminar. Everyone knows business model canvas, the Stanford biodesign process, especially for early stage. You can sketch it out in a systems diagram. What I use is what we call the 8-point checklist, which is really 100 questions. And you can go to our to the link when it's shared and look at the different categories and the questions and also the supporting material that you might need to prepare that. So this is just an example. So if you're talking about the category being requirements and the psychology, understanding what's the academic literature and putting that as part of your package, you can work through this process. It is helpful. And then you also maybe want to reflect internally as a founder, why are you doing this? And that will be also part of your story. I'm not just talking about personally why I'm doing this because I'm passionate about something. You also need to align the business with your careers and your ambitions in the next 5 to 7 years, however long the business is, so that the VC and you are going into this relationship with the eyes open. So then we come to communicating the proof of work. So it's amazing that people who are from the scientific and the research background, we know that this is important in your day job, your field. But then when it comes to business, because we always think of business, some part of it is marketing and communication. So So we drop a little bit of the details, but the truth is that the showing the proof of work to the VC is very important, because that VC will ultimately need to communicate that into an investment memo. So one of the ways of doing that is obviously business plan. A bit old-fashioned, but actually there's a lot of benefits to the format. Number one, it's searchable. So for a VC, it's much better from a searchable format. Then we can also replicate, let's say, some of your descriptions into our investment memo, which is likely going to be a document anyway. So that is still, I think, quite useful in that sense. It gives you a very structured way. And then there are other kinds of outputs that you do. The intro deck, which is what we call the reading deck, is what you send through and people can read it and they understand what's going on. I would generally include these 5 points, which is the problem, what is it, the market, why is this the place you want to focus on, how does the solution work from a performance perspective, and then some economics and exit pathways, the financials of business, and then lastly, why you, the team and the creds. So that would be what we call the teaser deck, non-confidential. Then when you hopefully get to meet the VC, then you have an intro presentation deck, which is more visual and it's more emotional and communicative, less of a reading kind of a deck. Then you might have an extended deck, which has a lot more details, maybe a bit more sensitive materials go into that. And then ultimately also preparing the data room and the DD materials for the VC. So remember, when you're starting off, just be comfortable. And I think that's something that VCs are comfortable with as well. It's not going to be comprehensive, but you need to at least know what you know and what are the blank areas and how you plan to find out. So if you're starting a company, you may not know what are the reimbursement codes, what is the regulatory, but these are things that you can search. These are things you can do a little bit of background and ask people, or figure out that within a certain budget, I'm going to be able to get a regulatory advisor, a reimbursement advisor to get that information. But you need to know what you don't know and plan to find out. So let's just acknowledge that asking for money is fundamentally awkward. So rehearsing is very important. I would recommend doing at least 3 different formats of what we call the pitch. There's a 3 to 5 minute elevator. There's the 20-minute if you're doing a 30-minute call, and then there's a 40-minute which gives you 20 minutes FAQ with the VC. And I think one of the tips is you want to anticipate the questions they're going to ask and prepare your answers in advance rather than them catching you off guard. And just be comfortable with asking for money. I am asking for something to do whatever is a value inflection point, something that's concrete rather than I'm trying to cure cancer. I have to do something specifically with the money to get to that inflection point. So we have to be quite practical on how you're using the money. And then in terms of how much you're looking for and what the valuations are, I would say it varies from company to company and market to market. But generally, you can look on websites like Crunchbase, there's a lot of public data, Tech in Asia or E27 to find out people who are what we call comparables, startups who are similar to you, what they raise, and then you can make certain assumptions on what their valuations are to help you understand how much you are able to raise and at what kind of a valuation range. So Google is going to be your best friend when it comes to finding out information for VCs that you're targeting. You're going to look for example, past investments. If they have invested in a similar space, what are their fund parameters? So sometimes VCs talk to the media and they'll say, I'm interested in X and Y and this and that. That gives you an insight to their priorities list. If you can figure out what is their fund parameters, we call that time horizon. Do they need to exit the companies within 5 to 7 years, 10 years? Do they have geographical restrictions? Like we only invest in Singapore, we only invest in Southeast Asia, and then maybe do a little bit of LinkedIn stalking or website stalking to figure out who are the gatekeepers so that you know these are targets that I need to get through. So I've listed a couple of sources down on the screen. The map of money, I think is fairly comprehensive, broad, but maybe a bit high level. You can also look at our website to figure out some of the partners that we've accredited along the way who have expressed an interest in this space. And in terms of how you reach them, I think this is something that you probably need to do some research on your own as well as a business owner. There are 4 different ways in which you generally do this kind of interaction. It's earned, which is via events or PR, so engaging with the media to get your story out. It can be on your channel. So if you've got blog or you've got some online influence, then you can use those. My preference is social marketing or social introduction. So getting somebody who knows the VC to make an introduction to you, that's always a bit more safe for the VC and a bit more validated. But the truth is, if you don't have any context, direct introduction, via LinkedIn, paying for a professional email is fine as well. We are quite used to it as part of our job. So I think that's always an option that I wouldn't disregard. And then engaging the VCs phase 2. So this is the image that what we think about when we talk about engaging VCs in the past. There's a lot of events and networking and stuff like that, which is kind of, to a certain extent, how it worked. But I think now a lot of things are going online. So it's a bit more like online dating than it is like events. And remember, you are also still in control of this component to the extent that you are reaching out to them. But obviously, sometimes they take time to respond to you and so on. So that part, maybe you are less in control. But this is a big part of the timeline, I would say. And the objective of engaging is getting to the term sheet or any kind of confirmation of interest. And then if you are looking for someone to kind of structure and price the round, then the lead investor is who you want to get a hold of. Okay, so everything comes down to getting the objective of hitting the term sheet. Now, I'll explain to you why sometimes you may not get the term sheet, you'll get some other kind of indication of interest. So getting to the yes, this is the VC engagement process that you can kind of expect. First meeting after the introduction or the connection, you might do a call, you might do a first meeting, but it's fact sharing and fact finding. So you are sharing about yourself, but you're also finding out about the VC and whether or not the dimensions that you are interested in, the timelines, the amounts, lines up with what the VC is able to do. But a big part of this is also rapport building. So that's why we always make the presentation shorter than the meeting itself, so you can have conversation and you can find out if this person is someone I'm going to be working with for the next 5 to 7 years on a daily, weekly, whatever basis, whether I'm comfortable with that person. And I think the VC is also going to be assessing you on that basis as well. You're going to want to write down any questions that come up and respond within 1 to 2 weeks. That's always good practice. And if you don't know the answer, you can always say, I don't know the answer, but you have to address any kind of challenges that a VC brings up. Then that's actually a very good way to get introduction into the second meeting, is whatever questions they raise to follow up. I have the answer for you now. Maybe we can talk about it in person or we can have a call. This is where the opportunity is for the VC to maybe fill in some gaps from the first meeting, maybe to even bring more people in to present upwards, what we call it. And this is a good time to put in maybe some sweetener, some sensitive information, some news about the company that kind of shows, oh, you're developing from the first time that I met you. And I think for VC side, the little secret is that when we share it at deal flow, so deal flow is something that we discuss weekly on the deals that we're working on, that's a sign of commitment. Because the VC is saying, I'm actively looking at this deal right now. So if they've shared it at deal flow, that means that they are at least getting into the due diligence of the deal. And it really depends from VC to VC when they're comfortable, but that's usually an indication that they are reasonably interested. Then they might get into early due diligence, which is generally going to be desktop research on the materials that you provided or about the market. You can look at the SBCA to find out a bit about term sheets. And I'll say, not all VCs will give you a term sheet. A term sheet simply talks about the amount that they're willing to commit, maybe some range about the valuation. Most important to me is actually the no-shop. So no-shop means that you're locked in with a certain period where you are not soliciting other VCs to lead the round. That's always a good indicator of the timeline that the VC has in mind to close the deal completely. So if you do get that, then I think it's a nice way of kind of having some solid proof, but not all VCs actually use a term sheet. So for us, for example, we may not use a term sheet. We might issue a term sheet very late along the way. It's all to do with certain levels of approval. So you don't always have to expect a term sheet, but if you do, then those are the things that are important. Once you have the proper kind of indication of interest, then you get into the formal process. So this is where you are no longer in control. The VC is in control. They have a structure. And the purpose of going through this is ultimately getting to approval to invest. So we talked about no shop that might show up in the term sheet. That gives you 60 to 90 days to close. So that's an indicator for you as well. Then we'll get into usually advanced due diligence, so more sensitive documentation, maybe some calls and validation with your partners, your collaborators or people that you sell to, your clients, whoever. That's the more heavy stuff that we will get into in advanced due diligence, where we're kind of committed to the deal already. Then if the VC doesn't share with you, I think you should always ask, what is their process for approval? Because it varies from fund to fund. Sometimes in a corporate fund, for example, there might be a sole decision maker up to a certain amount, which can make the decision. Then you know that's your KOL to go to. Some VCs have like 5 people on a committee, and all 5 need to give you a yes, and they are in different time zones. I'm not saying any specific examples, but that's happened. And then you need to talk to them one by one and get approval. So that reflects on your timeline, but you should know that that's their process. And then for us, it's a little bit more straightforward. I would say we have the CEO and then the IC level of approval. So I can give you a sense of the timing on how that would work. But when you know what the decision-making process is, then you can also budget from a time perspective and what you need to do to get to the approval. Then once you have the approval to invest, you are in the end zone, whatever it is. I'm not good at sports analogies, but you are in the end zone. So you are seriously no longer in control. The lawyer's in control until you exit the company. So the purpose of this is you have the approval. Now we need to get to the documentation to receive the funding. So this will involve what we call completion documents. I'm not going to get too much into the kinds of documents. That's reading material you can look at, SVCA as some examples. This is when you really need a good lawyer, legal vendor to advise you on the process, to also talk to you what are the implications of the different terms. And I think some people get on seminars and talk about, you know, what is the meaning of this term and that term. It only is important in the context of the document itself and what are the risks associated with it. So have budget for a legal advisor, ask for recommendations, ask for track record. I'm surprised that people are embarrassed about asking for track record, but you want to know that they've done deals in this stage, in this region, in this size, in this category, so they can also advise you on whether terms are standard or terms are unusual based on their experience. That will also help you understand that whether this term is onerous or it's fairly standard from a legal perspective. And then they'll also be able to represent you in the sense of conflict resolution. So a good lawyer will be able to take your side, but also understand the other person at the other side of the table and help you figure out what's the middle ground that makes sense for both parties. And that comes with experience. So these are a couple of names that I'll throw out. They're people that we have either worked with. So disclosure, we've worked with Denton's, Law, WMH, but we've also evaluated a couple of the others. And I think these are a good list to start with, but don't take this as comprehensive. You should go out, you should ask for other leads and make your decision, but these are just some that you can kind of start with. And then I think there were some questions around raising during the pandemic. So we've got bonus edition pandemic. I will caveat this part by saying that I think a lot of people want to talk about giving you advice about raising in the pandemic and some unusual circumstance. Personally, I find that it's a bit challenging for me to advise you because we're all going through it. So we don't know what are the lessons learned. We don't know how it's going to turn out. We can't predict the future. We can only live in it right now and give you advice on what you can do as we know the situation. And unless you've lived through the Spanish flu, you won't know how this ends, and we all don't know how this ends. So let's just be conscious of that when you're taking advice or anything of that sort. But the challenges that we've seen right now, number one, can't perform due diligence. So if you're doing any kind of hardware or you're in a different geography and just by travel movement restrictions, people can't do due diligence on your company and see that you exist and your hardware exists, then that's just something you can't avoid. That's just the reality of it. Number two is inability to deploy funds. So some VCs might have frozen deployments, maybe because of feedback. If they're corporate, they might have a strategy change or at least a strategy in flux. Then they may not be in a position to deploy. So it's nothing to do with you, it's an internal thing. Then there are certain value inflection delays. Let's say you're waiting on a regulatory approval, you're waiting for a commercial contract to be signed. These things are all being delayed now. So we're conscious that it's not you, it's not your fault, but if these are contingent to the close, then we know that there's going to be some delays associated with this. And then lastly, the market has changed. Hopefully that's not something that's going to impact you, because to me, market exchange is an opportunity. These black swan unpredictable events accelerate the pace of whatever it is that technology is enabling. So to me, market exchange means it's an opportunity actually. So you talk about telemedicine, in the past, people thought, reimbursement is not very favorable for telemedicine, but now things have changed. So it opens up new opportunities and accelerates certain kinds of changes. So the tips are always future-proof when it comes to these kinds of events. You know that there's a certain trajectory where technology is taking things to. So for me, the important things are decentralization of workflows, decentralized sensing, remote services. If you are kind of playing in those trajectories, the time horizon is things that we could not anticipate, but we know that those are the endpoints that we're going towards. So if you're along those lines, then I think you are reasonably future-proof. And then it just comes to the hard tags of being an entrepreneur and being a founder of a business, making some tough decisions, which means managing your cash flow, cutting your burn rate, ensuring that your timeline and your fundraising may take a bit longer. So you just need to manage from your side. So that's totally in your control. You can also look at other kinds of interim funding. There are certain grants and support that could come in as an intermediate step. And then there's always the possibility that you may need to go on hiatus. It's a worst case scenario, but I think that's something that we just need to recognize that might happen, and you just have to keep that in mind. I think the positive spin on it, the upside, is that from our own portfolio perspective, half of them raised up rounds in the first 6 months of this year. So people are still deploying. There's still people who are interested. It's just a matter of finding those people, figuring out that they can deploy, and then working with them to get the funding done during the pandemic. So wrapping up, what I talked about is the why and the when of VC. I think if you want, you should maybe do a bit more research on yourself as well and figure out, is VC the right vehicle for you? I talk about the 4 steps or more of generally how you structure the fundraising process. Talk about some of the kind of challenges and issues you should consider during raising in these times. And then I think lastly, we can go into a bit of questions if the floor has some questions.
Okay, great. Thank you very much, Augustus. Please raise your hand and we are ready to answer some questions. Victor is here. Let's see. Okay, I think we have one question, sorry. I can't see the hand. Okay, Arun, I unmute you. Yes, Arun, please go ahead.
Hi, good morning. I just wanted to ask this question. So thank you for taking my call. The question is, does SGInnovate just focus on Singapore-based startups? They also have a policy of investing in companies whose primary market is in the US, and there's incorporated in the US entity being a dominant entity, but also have a Singapore entity. So I think the question is, are there geographic preferences where the company is incorporated? Thank you.
Victor, do you want to take this one?
Yeah, I'll take this one. Thanks, Arun, for the question. So for us, we primarily invest in Singapore, but we do make investments also internationally when the companies are strategic to Singapore's needs, and we have made healthcare investments outside of Singapore. Having said that, we typically don't go into the deal unless, I think the key thing I think for everyone to also understand is that VCs like us would like to be able to provide value, right, to the companies we invested, and our value primarily comes from beyond the company building, and beyond the networks. Is also about what is our strategic value to them in Singapore and this part of the world. So ideally, the company would have some kind of business interest in Singapore and Southeast Asia, But yeah, so the short answer is yes, we do invest internationally, and the longer answer is that we want to invest in companies that we provide value to. So it's not everyone that we will look at.
Okay, great. Thank you. Thank you. Arun, is this answering your question?
Yes, indeed. So thank you. I think that was very helpful. Appreciate it. Yeah.
Welcome.
Okay, great. So the next question we have from Jen. Yeah, please go ahead.
Hi, this is Jens here from Origin Health. Just a quick question. So SGI has been investing in medtech in the last couple of years. So I just want to find out, how has the investment thesis evolved over the years? And moving forward, what's SGI thesis again when it comes to medtechs? Yeah.
Yeah, Augustus, you can take this
So
one.
I think when we started, we needed to have a landscape survey also of what are the opportunities in Singapore itself. That's something that I did personally, to see what are the categories that we can play in from a supply and from an IP perspective. So we know there are a couple of things that comes up a lot when you look at Singapore deals. Number one, historically, has always been in the cardio. Number two is in the oncology space. So these are things that just so happens there's a lot of supply. Then we also want to look from the demand side. So what are the exit pathways? What kind of acquisitions are being done on a global level? Because we can't always anticipate that acquisition. And I think probably for healthcare in particular, you can't anticipate that the buyers are going to be in your market. They're going to be global deals. So we look at the trends and what people have done in each of these categories to see whether there's a track record. So for example, cardio is a long track record. Other things may have less of a track record. Then that gives us a sense of what people are buying or what people are interested in on a global perspective. Then we think about what is the Singapore value add. So do we have the right patient populations? Do we have the right specialization? So an example is, let's say mental health, for example. So we know that Singapore has the number one rate of major depressive disorder. So in Asia, so there is patient population. But are there lots of solution providers in market? I would say less so compared to cardiology. So then we might need to look at solutions that could apply to this market, or have an interest to apply to this market, and look at it from that perspective. So that is the way that we generally formulate our thesis. We think about what do we have in our market from a supply side perspective, what do people want globally from an acquisition perspective, and then we also think about what is the patient populations and the data that we have a unique place to play in from Singapore side, and then we kind of narrow in on the opportunity spaces that we kind of focus on and source our deals. That's not to say that we don't look at things that are maybe outside of those spaces on occasion, but generally because we have such a large portfolio, we also want to be a bit more focused in the areas that we think are the most meaningful and the most impactful. And so having a thesis actually also differs from VCs to VCs. So I would say that if you're dealing with a VC that doesn't have a long track record in healthcare, and that's to be expected in the maturity stage of our ecosystem, they may not have a first strategy from the start. They might look at a couple of opportunities and then work their way towards some kind of a cluster strategy. Or they might come in, maybe if they are corporate, for example, they have an agenda in mind on these are the things that I'm looking at from companion perspective or from a business unit perspective. Then they are quite upfront. I will only look at deals in this space because otherwise it doesn't make sense to my business units. Then you're not really within their parameters.
Okay. Can I just ask a follow-up question on this?
Sure.
Yeah. So I mean, Augustus, just like you gave the advice to us that we should always ask the VCs about their evaluation process. So I'm going to throw this question back to you. So like for SGI, what's the evaluation process like when it comes to medtech startups, and also how is it different from the typical institutional VCs here?
From a typical institutional VC, I can't say because I'm not in an institutional VC. The others, I work with some others. So like I said, there are some that have a whole panel of GPs. that will have to come to a consensus before they go in, and that can delay the process a little bit. Or it could be, I think I would generally expect it to be kind of a GP setup where somebody brings on to the table and then there's a vote and then they decide on what to go ahead. Usually a lot of the initial materials will be done by the analyst or associate if they have that kind of a structure. So you have those gatekeepers that are sourcing and preparing the shaping the initial deal before it goes up to a decision-making level. So from our side, we're fairly flat. So all of us do our sourcing and putting the materials and presenting to our investment committee and CEO. And so in terms of how we evaluate, we are conscious of a national story and thesis, like I mentioned, and whether that fits within the parameters that we've drawn up. Then we're also conscious, and this is where it comes to stakeholder management and KOLs. We understand, for example, after working with some time, how our investment committee thinks about healthcare. What are some of the areas that they will want to focus on? And likewise, CEO, what kind of information he is generally inclined to. Because when you get to that stage of presenting, they are not going to look at everything. There are some things that they will think are salient as part of the deal, and that will vary from VC to VC and from case to case. And if you're working with a good, I think, associate analyst, whoever who's putting together a deal with some experience on that part versus someone who's just presenting the first time, then I think you're a bit like shooting in the dark. But that person will generally know how the stakeholder thinks about it. Then they will help you as the founder prepare the relevant materials to go up to the decision maker. So sometimes you get to actually present directly as a founder to the decision makers. In our case, you don't. It's all mediated by the people like myself. So then you have to make sure that the materials are there to communicate that story on your behalf.
Okay. Oh, Victor, do you have anything to add? Or?
No, I think for us, as Augustus shared, our process is fairly flat, right? And I think most of the guys who lead the various verticals, Augustus, for instance, leads our healthcare side. They have a fair contribution in terms of what they share at the meetings, and all of us would come to some kind of conclusion. Most of the time it's around not wanting to waste the time of the entrepreneur also. So if we internally understand that this is a deal that's going to be tough to pass through, whether it's in terms of thesis or in terms of just not being that relevant, then we will let the entrepreneurs know as early as possible. So I think there's a whole bunch of reasons in why we will say yes or no, and I think we are optimizing the process, for so that we don't waste the time of the entrepreneurs when they're raising funds also.
That's great. Thanks a lot, Augustus, and thanks, Victor, as well.
Yeah. Thanks, Jans, for the question.
Thank you.
Okay, great. We have another question from Srinivas. I'll unmute you. Okay, go ahead.
Yeah, hi guys. Thanks for the presentation. Srinivas here. So my question is specifically for local startups that have, let's say, received approval for the ESG POC POV funding, but that's not sufficient for them to accelerate, to develop, let's say, a class 3 device. So would such opportunities fit into what you're looking to invest? Would it be looked at favorably or not favorably? And what's the ticket size of your funding?
So POC POV is a grant in that nature. They are evaluated on those premise. So their evaluation is a signal of some credibility, but it may or may not converge with the kinds of risks that I talk about. Most often, I would say that if you're looking at POC POV grant, they probably converge around technology risk, which I think is fine. We are fairly comfortable that as a signal of what kind of the technology risk is involved with it. But there are other risks, like I mentioned, commercial, as well as regulatory risks. Regulatory, I'm not really so concerned, but I think probably more the commercial side. Then that may or may not be answered by the materials that you put together on the POC POV. So it really depends on what the materials are on a case-by-case basis. So you're talking about class 3, most of the indicators that we're seeing, for example, the deal records, very often the amount of money and time it takes to get to market is very extended. So that means that especially if you're in a breakthrough category, you're opening up a new market, then the expectation is that you're unique enough that maybe you will be purchased early on. And we've seen some data around that in US deals. So you may not get to the stage in which you are being asked to distribute and commercialize and figure out your reimbursement and so on. So that may not be part of the consideration. So it really depends on what's your pathway based on the risk profile that your device is in. Then we will consider these are the risks, these are not the risks. For a lot of devices, we would generally assume that you're working with a distributor, whether it's a larger organization or someone regional like Transmedic, who works with NDR Medical, a lot of experience in robotic distribution in Southeast Asia. Then I don't expect you as the founder to be in charge of the distribution process, because medical devices are challenging to distribute in multiple markets where different regulatory requirements lie. So then that risk is kind of moved from you to someone else, and we understand that will happen.
Sorry, just to clarify there, so would concurrently raising money from SGI, as we are still in the POC POV funding stage, is that possible? Have you looked at such deals?
Yeah, there's no the POC POV, whether you have it, whether you don't have it, whether you've already taken it, whether you're now applying for it, has no impact on my decision on our evaluation. That is just one data point. So if you're looking at maybe some other companies that are not applicable for POC POV because of the ownership structure, they are not going to go down that lane anyway, but we can still look at it from an opportunity standpoint. So that is just one data point.
Okay, thank you very much.
Okay, great. So we have time. So we have a question in a chat box from Elaine. I will unmute you. So given the current volatile situation, how is it impacting valuation of startups by VC?
Okay, I'm not sure whether we would consider, I'm not sure whether you would say it's volatile. I'm not sure. It depends on what you mean by volatile. If it means that there are some sources of funding that are I wouldn't say drying out, but they are paused right now and are not accessible to you, that means that your sources of funding are reduced. So we are currently looking at a deal where they were previously talking to a VC in another market since December, let's say, but if they're intending to close this year, there's just no way that due diligence is going to be done in that way, in that pathway. So then they have to look for VCs domestically, which then narrows the sources of funding for them, which then means that it's a supply and demand question. They are going to offer you what it is, makes sense within the constraints. So we have scenario in which if you only have access to locals, who are closer to you, then there might be fewer sources of supply of funding, which may impact the dynamic of the buyer and the seller. So I think that's natural. Whether overall across the board, everyone's going to take a hit on valuations, I don't think that is necessarily the case. I don't think that means, it really doesn't mean anything on that side, because valuations are also an art and a science. Is a meeting between what the VC thinks you're worth right now and what you're willing to accept. So ultimately, that's the valuation that gets reflected in Crunchbase and so on. So it's still a negotiation, but maybe they want to try to be more aggressive. I don't know. It depends on the dynamic with the VC. But for the ones that we've done in the last 6 months, I haven't seen anything that differs from the comparables pre-pandemic.
Okay, great. Aline, do you want to respond, or it's okay?
I think I'm okay. Thank you so much.
Okay, great. Thank you. So the next question we have from Patrick. How do you de-risk in the 3 areas? Maybe I'll unmute Patrick so he can elaborate on this. Patrick?
I think he's still muted.
Hello, hello.
Here you go.
Hi.
Hi.
Hi. Yeah, so there were 3 areas of risk, right? So like if you're in preclinical studies, how do you like show that you try to de-risk in the technology area?
Okay, so it depends on the nature of the device. I'll talk about product number one, and I'll give you an example for NDR as well, because I think that's the most concrete example of risk. So one of the value inflection points, as we all know in healthcare, especially for regulatory submission and IRB and clinical trials and all that, is first in man. Okay, so you need to get to the stage in which people, from an ethics perspective, are allowing you to do first in man. And there are risks associated with that. And so therefore, when you have done first in man and you publish the data, you have de-risked something. But when I think about what is the significance of first in man from an engineering perspective, is it very different from being able to repeat the procedure on a gel model in a controlled environment? Is it very different from being able to do that in a pig model or a sheep model? And in some cases, you are doing a high-risk device. The kinds of data that we're going to have at the early stage, pre-first in man, is going to be an animal model, a gel model, and then I will need to understand whether depending on the stage of development, let's say you're on the final stage already, the design is largely finalized, it performs within the relevant thresholds that are acceptable. So the tolerances is a single trajectory within the gel model and the animal model. Then I can make some assumptions that when you do it on a human being, it should be repeatable, the success that you have shown. So even though first in man has certain connotations, obviously risk, because a patient is involved and you go through IRB, from an engineering perspective, the machine performs as is required within reasonable thresholds before that, so then I can accept that it should perform in a similar way in a first in man. So when we did that deal, for example, we talked to our GM at the time, and he's from engineering, and he says, looking at the nature of the device, it's an engineering problem. It's not a human problem. It's not a biopharma. You're not metabolizing anything. It's an engineering problem. So provided what you have shown is potentially repeatable and performs within the parameters and the endpoints that you need for first in man of a clinical trial, then there is sufficient data to believe that you will be able to do that just based on your preclinical data.
All right, thanks.
Okay, great, thank you. So we have the next question is from Sunil. What is the decision-making process like at SGInnovate when it comes to potential investments? I will unmute Sunil. Okay.
Hi, I just wanted to find out, like you was mentioned about how some VCs have 5 GPs approval required or investment committee approval required. So just keen to find out what is the process like at SGInnovate if it intends to make a investment. Does it have an investment committee, or how do they go about the decision-making process? Thank you.
Yeah, so I think I touched on this a little bit, but we have generally 2 levels of the formal process. Number 1 is CEO level, so presenting to CEO, getting approval, and then number 2 is presentation to the investment committee. That can be individually, it can be collective, it can be via circulation. So when that one we need consensus, and then when we get those 2, that's part of the formal approval process. Of course, there are informal levels of approval that you can say precludes that process. So that means bringing it up at deal flow to ensure that Victor and head of investing has kind of buy-in, and they have a lot of experience dealing with the investment committee, so they can advise on whether this is a deal that makes sense from a a positioning, organizational perspective, but also maybe some of the other dynamics as well. So generally, I would say, from my perspective, when we put it up to CEO, we put it up to investment committee, we don't want a scenario where they're going to reject the deal. So we want to try to de-risk based on how we know they think about it before we even go into that approval process.
Thanks for sharing.
Sure.
Okay, great. Thank you. Our next question is from YL. Do you look beyond financial objectives for your fund? For example, strategic. I will unmute YL.
Hi, thanks. Yeah, so I just wanted to understand, like, what would be your criteria? Would it be beyond just simply profit maximization for the fund? Thanks.
Yeah, it would also be health outcomes. If we're looking at healthcare, I think we're not just looking at things that are purely profitable. We believe that, and I think most VCs who are looking at healthcare are looking at the double bottom, which makes it a little bit different than, let's say, investing in an e-commerce or purely financial play, where you're simply looking at the optimized outcome. For us, we're looking at some national objectives. We're looking at impact areas that we think technology can play a role in, and we want to be involved in those kind of solutions. So it's not just a financial part. A financial part is the bread and butter, is the basics of a VC consideration. And all VCs, and in fact all fund managers who are professionally responsible for their fund, have to ensure that that base level is covered. Then there might be other parameters like the health outcomes that we would consider.
Okay, great. YL, any further questions?
No, thanks.
Okay, thank you. So I think we have time for another last question. Is from Srikar. I will unmute him or her. Just 1 second. Srikar, can you speak?
Yes, hi. Hi, it was a great presentation. We got a very clear perspective from a VC. So we are a medical device startup based out of India, developing minimally invasive solutions in the specifically in women's health, and we have done our first in women's studies in this case, and the results have been extremely encouraging. Mm-hmm. So I have two questions. One question is specifically on the due diligence. So I'm sure you guys must be evaluating new technologies. Are there any new ways on how you are going about due diligence, unlike the due diligence process which you are doing in the past? And the second question is, we are also in constant touch with the corporates, the bigger medtech companies who are also showing interest in having an early collaboration. Mm-hmm. Would this be considered as a positive aspect from a VC? I would be glad to get your insights on that.
Okay, so there are 2 points. In terms of how we would look at a deal like yours, for example, I think we will go back then to the teaser deck that I mentioned before and some of the key points, and this is very universalizable to your startup as well as to other VCs. So number 1 is calculating or valuing the problem. So figuring out how large is the area in which you're applying this technology to. How much does it cost right now to the health system? How much does it cost from a litigation perspective to the medical providers, to the insurers? So how do you value that problem? And this is something that is a bit sensitive when it comes to healthcare, because healthcare is a infinite, like there's infinite demand for healthcare and all different kinds of healthcare, and some of them have a way to be met from an economic perspective because they are something that is already being paid for and there's existing behavior for it. When it comes to new technology, sometimes they go into areas where the economic meeting point has not met, and so therefore it's challenging to kind of solve them from a business perspective. So we're conscious of that. So that's why we always look at what is the problem and how do we value the problem, who values the problem. Then we look at the market. Is it reasonable enough? Is it large enough? that if you maybe get acquired and you then fall into a wider distribution, whether you have a reasonable impact to their value from a product perspective. So I'll give you an example. One of the corporates that we talked to, who is very large, and if I said the name, you would know them. They would say that they only look at things that move their bottom line from 1 billion perspective. So if your market is not big enough to do that, don't even think about it. They are just not interested. So that's why we always talk about markets and why having a large market is important, even now, considering it to the point in which they are acquired. And the reason why we think about that is generally medical devices get acquired. The reason being is obviously number one, distribution. There are only so many devices, large device companies, and they take up the mind share and the distribution and the attention of many markets. They are the big guys. You have to work with them to get into the workflow, just to get your product out there. So we are conscious that medical devices, and the data shows that, are designed to be acquired. So that's the pathway you would generally go down from that perspective. So that's why we think about market. Then you look at the solution component. What are your performance parameters right now? Do you have some data? Is it published data? Is it data that is private, but you can show repeatability of certain performance? Then I think that's a consideration on evaluating the solution. Then we talk about economics, whether there's enough margin on whatever it is you're doing based on how much people are willing to pay to, pay your salary, pay your headcount. So those are basic bread and butter economics questions. And then exit, do people buy things within this space? And I mean buy in terms of buy the company. Do corporates have a history of buying companies within this space? How much are they buying it for? Over what period of time? At what stage? Then that helps me model right now whether you are one of those things they can potentially buy. And that leads to the corporate question. What does it mean to work with a corporate? Corporates like to work with startups, I think, for various reasons. One is obviously they want to be involved with the innovation out there. Number two is that they're looking for new things, potentially to add to enhance their existing lineup or their products. So I think it's always a good sign it's a good sign early on that you have some interest from the corporate who may or may not be a potential buyer, even if they don't have cash flow or balance to buy. Maybe it's a signal that somebody else in that space might also be interested. So the corporate engagement is something that you will want to manage from an engagement perspective. Let's say you get into an RCA, a research collaboration opportunity. Reading between the lines, it can be quite clear on what is the level of interest from the corporate, because I've seen some of these and they actually put down very clear milestones on what it is and how much you get paid and what stage we talk about, IP and distribution and so forth. So those are generally quite clear. That will give an indication to me as a VC, what are the parameters of this engagement, how serious it means to be involved in this corporate, and also a little bit about what are the parameters that they've drawn. So if you're a platform, for example, you can do an RCA exclusively with one corporate for a particular application, but that might still leave you, depending on how the RCA is structured, to have another application with another corporate in a completely different and exclusive space. So it can be structured in such a way where you manage that relationship with the corporate while having that kind of crystallize their interest in you and your space.
Thank you.
Sure.
Okay, great. Thank you very much. Great insights from the experienced people from SGInnovate. We learned a lot. We are over time, so sorry, we don't have time for another questions, but feel free to reach out to us at APACMed or to Augustus at SGInnovate. You have the details in the presentation. We will send it over to you. And thank you for joining, and thank you, Augustus and Victor. Thank you very much, everyone.
Thank you, everyone. Thanks
so much.
Dana.